Welcome to the Executive Corner, Expert Talks by Kalkine TV. I'm Sage, and today's guest is Mr. Alex Brammer, the VP of Business Development at Luxor Tech. This is North America's largest mining pool operator, supporting 15 different cryptocurrency coins and over 8,500 miners or thereabouts, and they are experienced in delivering high-quality pools with strong uptimes and customer service, and are thrilled to bring this knowledge to the Bitcoin mining industry, in their own words from their website. And whilst the price of Bitcoin is nearing its all-time high, the crypto space is buzzing, which puts the crypto miners in the spotlight. And as you know, we bring you the industry advocates and successful business leaders to help you discover the insights of the stock markets. And bringing you live today, we have Mr. Alex Brammer, the VP of Business Development at Luxor Tech. Welcome to the show, Alex.
Hi, Sage. Thanks so much.
Thanks for making time for us, and we're keen to share your insights, so let's get started. So Luxor Tech started with a small team of developers back in 2017 and with 2 public mining pools in 2018. Now you are North America's largest mining pool. Could you please share your journey of achieving this incredible accolade?
Yeah, absolutely. Started in late 2017 with a couple altcoin pools, Zcash, some of the Equihash consensus algorithms. Also, Saya, one of our founders, was a core developer on the Saya project. That started expanding into Bitcoin space. We launched our first SHA-256 mining pool in 2019. And this year, really, this bull cycle has been kind of a banner year for us. Closed Series A financing in April, led by NYDIG. We're currently sitting at right around 6 exahash, which is right around 4% of the Bitcoin network. So we're really just proud of what's going on in the space, proud of what we've been doing. The mining space has been very interesting, and so we've been expanding beyond just the pool services, really focusing on kind of mining consulting advisory services. As mining popularity increases, the margins are continuing to increase, especially with the price action that we're seeing today. And recently, it's becoming increasingly popular for high net worth individuals, family offices, hedge funds even, to want to allocate into Bitcoin mining and start investing directly into infrastructure and mining themselves. And so it's something that we've been focusing on a lot as well.
Fantastic, and it's great to see those high net worth individuals and institutional investors getting involved in the cryptocurrency sector too. So Luxor Tech has mining pools for many altcoins, and you've touched on this a little just then in your response, and in 2019 added a Bitcoin mining pool. What were the main reasons for beginning with the altcoins? You did say you collaborated with Saya to begin with. Could you just elaborate a bit more on that, and why is Luxor Tech still classified as a mining pool rather than a farm?
Sure. So to touch on the first question, the Bitcoin code base is very complex, and it's also very high consequence. So when you're building, anytime that you're building something that's new technology, new engineering, you want to do it in some kind of a sandbox first. And the value of Bitcoin that is transacted, that pools process, the hash rate that pools process is very large, right? So it made sense for the developers, for our founders, to start in the sandbox that is altcoin pools, a little bit more low consequence. And then once all of our systems were kind of instantiated and had been battle tested and hardened, that's when we kind of transitioned over into the Bitcoin side of things. And obviously that's now our core business. To the second question, so I think a terminology clarification would be useful here. When you hear, and this is probably very useful for your audience as well, because you hear a lot about mining farms and mining pools, and some people kind of question what's the difference. When we talk about a mining farm, we're talking about a data center. So we're talking about a physical space, whether it's containerized data centers and things that look like shipping containers, or it's in large actual data centers like hard stand structures that are holding the ASICs, which are the computers that are actually doing the mining and the proof of work algorithm, SHA-256. A mining pool, on the other hand, is really a software platform that buys all of the hash rate from these mining farms, aggregates it, and then mines it on the Bitcoin on the network itself. And we basically pay the miners for their hash rate, and we take a spread, which is how we generate revenue. A low percentage spread. The reason why mining pools were invented is because of something called luck risk, which is essentially the chances of even the largest mining farms in the world now, and some of them have well over, they have multiple exahash, they could go 30, 60, 90 days without ever finding a block, and therefore without generating any revenue. So it's a really tough thing to invest in a company that has such um, irregular revenue flows or cash flows. And so what mining pools do is they smooth out mining farms' cash flows by assuming a lot of that luck risk. And we do that. The way that we're able to do that is because we are so large. Like Luxor is 4% of the network hash rate right now, and so we find blocks and we're able to generate revenue for our miners just very consistently with very little risk.
Thank you so much for sharing your strategy with us. And if I understand correctly, miners pay fees to mine crypto. Would that be correct?
They do. So there's what's called pool fees, and so there are multiple different models of pool fees. And I'll rattle off some acronyms here, and it can be some research for later on. The original was something called PPLNS, or pay per last N share, and so the miner basically sells the hash rate to the mining pool, and then when that mining pool finds a block under this model, that mining pool pays that miner back proportional to the overall pool hash rate. So if, for an easy example, if the mining pool has 10 petahash, the mining customer has 1 petahash that they're selling to the mining pool, that mining pool will pay them 1/10 of every block reward that they get, minus whatever the fee is. And typically it's between kind of 1% and 3% of the total revenues generated. Our model and most kind of newer pools that are operating in the space operate on what's called a full pay per share method, which is if you're a miner and we are buying your hash rate from you, we are going to pay you the expected value of the block reward, which is the currently 6.25 Bitcoin per block, 1 block every 10 minutes, and the expected value of what we think the transaction fees are going to be. So it allows the miner to participate in the upside of both the block reward and the transaction fees associated with that block. If that makes sense.
Okay, yeah, sure, it does, but it definitely will open up for our viewers and for me to do some more research on that. So could you help us understand how the price of the crypto and the gas fees relate to the miners' earnings? And Bitcoin halving happens approximately every 4 years. And is this relevant to the hash rate of the other cryptos too?
Yep. So the way that Bitcoin spot price affects mining revenues, and I'll talk in terms of Bitcoin specifically, just because it's the most relevant one. But this is generally true, more or less, for the other altcoins. In Bitcoin, so the mining revenue is determined by a combination of the Bitcoin spot price on the one hand and the network hash rate on the other hand. If you hold Obviously, if you hold network hash rate, and when I say network hash rate, I mean the amount of miners that are actually connected and mining on the network. If you hold that constant and the Bitcoin spot price increases, then revenues will increase. If you hold the Bitcoin spot price constant and you increase the network hash rate, mining revenues will decrease, because as the network hash rate increases, the difficulty of finding a block and the more energy that is required to be expended to find a block per miner increases as well, increasing the costs, the operational costs, or what we call OPEX, and therefore decreasing net revenues. So your second question about how this affects other cryptocurrencies, other proof of work cryptocurrencies, miners. There are other. Ethereum is obviously the most well known of the proof of work cryptocurrencies that are not Bitcoin. Most of your viewers are probably aware that they're trying to move to proof of stake. I am not aware of any strong correlation between that is directly related between the network hash rate on the Bitcoin network and the network hash rate on the Ethereum network. What I would say is hash rate typically follows price. So as price increases, hash rate on Bitcoin will increase. We also know that the price of Ethereum and Bitcoin are pretty highly correlated. So as Bitcoin pumps, Ethereum also pumps. And so by the transitive property, we would expect that as Bitcoin price increases, Ethereum price will increase. And as Ethereum price increases, the network hash rate on Ethereum will also increase as mining revenues, as mining profitability increases. The one thing that I would say that probably throws a wrench in that logic now is the transition to proof of stake. So if they do a full transition to Ethereum 2.0, that is, they basically have the beacon chain now, and if they go fully live and they translate that over, obviously the mining question is no longer relevant for ETH 2.0. Whether Ethereum Classic and other kind of forks of Ethereum continue to be mined is up in the air, but it's not something I really can speculate on because I'm not too keyed in on the Ethereum side.
Yeah, fair enough. That's quite exciting. They've been talking about this layer 2 for quite some years now, so it'd be nice to see it actually eventuate and get some closure on that. So, or maybe it'll open up so many doors. It's like a rabbit hole, isn't it, crypto? When you work out one puzzle, it leads to another. It's such an exciting space. So Luxor Tech developed mid-year crypto mining stock index. So this year, I remember reporting on it, a crypto mining stock index, and which is a basket of over 50 mining or mining adjacent equities. Sounds similar to the new ETFs that people are talking about. Can this index and the hash rate index be utilized to maximize profits from crypto trading?
Certainly. So the index, yes. Like if you're looking to get proxy exposure to cryptocurrencies, and the one that I'll talk about, the one that I'm most familiar with, like the example would be rigs. So the Breedy Funds Cleaner Crypto Mining ETF. It's basically just a basket of publicly traded mining companies, chip manufacturers, et cetera, people who are in that industry. If you're looking to get exposure through a proxy to crypto, these are good vessels to go with. The Bitcoin ETFs, they're all going to be good. You can put them in traditional retirement accounts, institutions that have risk management departments that haven't fully wrapped their heads around crypto, the issues of custody in crypto, the kind of different counterparty risk profile. These are great opportunities. There's a lot of alpha to be made, especially right now. Like we have a thesis that mining stocks are going to continue to appreciate and beat a lot of other market segments. And I should say not financial advice here, but just because of how profitable mining is going to be over the next few years, and how correlated the stock price of these things is going to be. So a lot of the other part of this is that, particularly, and again, I'll speak directly to mining companies because it's where I think I'm most qualified to talk. These mining companies, the analysts that are doing the valuations on these mining companies are getting much more nuanced in how they execute their valuation modeling, and so they're getting much more savvy on understanding operational efficiency, and so they're actually going to these farms. They're looking at what type of cooling they have, what type of airflow management they have, what type of electrical engineering they have, what type of security they have. How old are their miners? How often are they flipping their ASIC portfolio? And they're looking at things like how much Bitcoin do they have on their balance sheet? And so where before it was really just a question of like raw hash rate was kind of the valuation metric for these mining companies. Now you're seeing analysts that are taking a much more nuanced approach. And so the valuations are going to become much more, I think, accurate. And as mining profitability increases, it's going to become, they're going to be really high alpha stocks. On the, on the other side of the investing coin, my personal opinion is that like most of the things that I talk about with friends and family in terms of they're always asking how do we invest. I tell them to invest in the actual cryptocurrencies, and mine is mostly Bitcoin, and I would encourage them to hold their own keys. So these public market, instruments are very useful. I have them in my IRA. A lot of people use them for interesting things, but a lot of like hardcore Bitcoiners also just want to hold their own keys, and that requires self-custody.
Thank you. I guess it's just an indicator, and it helps you to give an overall picture of what's going on. Thank you for that. Yeah. So GPU supply chain crunch is causing waves for many industries. Do you see this having impact or any impact on your mining pools operations?
Oh yeah. I mean, it's not just GPUs. It's silicon wafers in general. It's everything that goes into making all the compute. So GPUs are kind of one subset. ASICs use an entirely different chip, but it's still made out of silicon. it's not just chip shortages either. So it's obviously very germane to this conversation, but it's affecting everything, right? It's affecting used cars are selling more than new cars because the supply chains are so disrupted along everything. So it's chips, it's steel. Another long lead item that is really complicating the build out of mining facilities, especially in North America, is transformers. So like all the steel, the copper, everything that goes into building both the large scale transformers that do the kind of high voltage to medium voltage step down transformation and the low voltage, like the 415, 240 transformers that do the mid to low voltage transformation. We're seeing backups of close to 40 weeks in some cases for the low voltage stuff, and out up to a year for the high voltage kind of substation level. Uh, all of this is having a profound effect on lead times for building out and deploying mining farms. And so it's partly why mining is so profitable right now, because the people that are up and hashing and already have their farms built out and they're producing hash rate are reaping outsized benefits, while the people who are trying to enter into the space are being challenged with these supply chain constraints, both on the chip side, which is what you mentioned, which is prohibiting mass production of ASICs to satisfy demand, but also on the more traditional infrastructure side as well. I mean, even containers, the steel for containers is backed up, and then you start to incorporate all the shipping challenges. Like the Port of Long Beach looks like, I mean, there's hundreds and hundreds of ships stacked up outside of the Port of Long Beach waiting to get in and access to the crane. So it's just it's soup to nuts on the supply chain that are creating challenges for Bitcoin mining.
Oh, well, I hope President Biden's infrastructure plan, I think he's got a bill that wants to start local manufacturing of chips. Is that correct? The infrastructure bill, or one of his bills, has mentioned that in the past. Hopefully he can find a solution to this demand.
Yeah, I don't know how much of it be him finding a solution. I know you got an agenda. Go ahead. We'll see. I think it's probably going to come from the market will help to fix this. I'm not sure how much the infrastructure bill is going to do for that, but.
Cool. Thank you so much. And we have to start winding up now. I wish we had longer to share your insights with our viewers, but crypto mining is often criticized for its energy consumption. And we've heard of people like the Cardano Foundation pledging to plant millions of trees to help combat their energy consumption. Is Luxor Tech doing anything to minimize their carbon footprint that you'd like to share with us?
Yeah, absolutely. I'll say two things here. One, I mean, we offset with renewable energy credits. And so having kind of dived down the rabbit hole of offsets versus RECs, like we really think that proof of work mining, Bitcoin mining, is as a function of its high energy demand and also its ability to be interrupted, meaning shut down on and off on demand, and its ability to consume stranded assets that are far away from loads. So essentially, like, in the middle of Iceland, they're producing Bitcoin off of geothermal energy that would not be able to be brought to market anywhere else. We think that all of this is really leading to a scenario where Bitcoin kind of accelerates the transition to a renewable energy infrastructure, kind of in the medium term. And so in the short term, we actually offset with renewable energy credits because those renewable energy credits go directly into existing renewable energy production facilities or power generation facilities. Which is really what we want to get after. And there's a whole there's a murky underbelly of global carbon offsets. There's a lot of scandals where, I mean, the Cardano Foundation may be planting a lot of trees, or they may be getting scammed and thinking they're planting a lot of trees, but they're not. So we tend to like to subsidize the actual energy generation. But yeah, we're very aware of that, very cognizant of it, and very bullish actually that Bitcoin helps to really accelerate the transition to renewable energies.
Great. Well, thank you so much. And technological developments are helping so many other sectors and industries to become more energy efficient and find breakthroughs. So hopefully further developments in the technology will help the crypto sector too. Alex, was there any final thoughts you'd like to share with us? Thank you so much for your insights today.
No, I really appreciate it. This is fun. It's fun to kind of have discussions like this outside of just the North American market, which is where we're predominantly engaged. And so, if anyone, I'll do a little shameless plug here. If anyone is interested in building a mining farm or getting involved in the space, we're happy to have a discussion. I'm on Twitter, Telegram, Discord, all that stuff. So feel free to reach out.
Fantastic. Thank you so much for that opportunity. And thanks again for making time to share your insights on Expert Talks by Kalkine TV. Your time is appreciated. And if you just joined us, we had a very interesting discussion with Mr. Alex Brammer, the VP of Business Development at Luxor Tech, and the full interview will be available for viewing via YouTube at Kalkine Media. And as we say, stay apprised and invest wise with Kalkine.